Okay, now let's work on the learning objective number 4. Apply the recognition and the measurement criteria of the conceptual framework to financial reporting situations. Okay, recognition and measurement criteria, right? So, like I mentioned, right, in the example of going to see the doctors in the clinic, right? So, recognition means you're going to recognize this item on the financial statement. And measurement means you're going to decide what is the dollar amount of that item, right? So first you have to be able to recognize it and then have to be able to measure it, okay? So accrual basis of accounting. So I think you have learned about this. So there are two different types of accounting: accrual basis of accounting versus cash basis of accounting, right? So accrual basis of accounting, they will record the transaction in the period when the event occurred, not when the cash is received or paid, right? So basically, the transaction is recognized because the event has occurred, has nothing to do with the cash flows. So whether you receive cash or you use cash, right? The recognition criteria will help determine when item should be included in a financial statement. Okay, so you recognize it. When are you going to recognize it? Okay. The measurement criteria provide guidance on what amount should be recorded. Okay, so recognition means when to recognize. Okay, measurement is what amount should be recorded. General recognition, an item is usually included in the financial statement if it meets the definition of an asset, liability, equity, revenue, or expenses. So normally they will be included in the financial statement if they meet the definition, okay? And it's probable that any future economic benefit associated with the item will flow to or from the business, okay? So this is just saying that it's probable you are going to receive the benefit. So that will be an asset, right? If it's probable that you are going to lose future economic benefit, or it's probable that you have to settle a liability by sacrificing future economic benefit, this will be recognizing the liability, right? So that event has to be likely, the future economic benefit, whether it's in or out, that future economic benefit has to be likely, probable. And it has to be able to be measured, right? The estimation on the amount has to be reasonable. Right? So when I'm saying, okay, I'm going to report my Vancouver house as $2 million, right? Is that estimate reasonable? Okay. Well, you will say, oh, yes, because it's made by the certified property assessor, right? And this kind of information will be even accepted for, let's say, a business loan application, right? Purpose, things like that, right? Okay, so you want to consider, is that amount reasonable, can be reasonably estimated, and it meets the fundamental qualitative characteristics, which is relevant and reliability, faithful representation. Okay, so I have a question for you. Okay, so you think about the university financial statement, right? You think about assets, My question for you is the university president an asset? Is your university president an asset to the university? Should university should we assign the asset value to having this president for the working for the university? Okay, so think about it and let me know when you are ready to talk.
Could you repeat the question, Professor?
Yeah, is university president an asset to the university on the balance sheet? Do you recognize the value of having this person as the president of your university? And what is his value? What is the value of that president, right?
So the question is if we consider the president or UCW a present asset?
Mm-hmm.
Oh,
yeah.
okay.
So would you say, under you have the balance sheet, right? You have assets, right? Section. Under the asset section, would you have a president? I don't know who is the president. So would you say this president and have a value of $10 million? Okay. Okay. Do you think we should recognize the president as asset to the university? And if yes, what is the measurement, right?
I don't think so, but I don't know.
Why? Why don't you think the president should be valued as an asset? Anna?
Well, I wouldn't know like what amount to put him.
Very good. Very good. Awesome. Yeah. So Anna is absolutely correct. So I cannot recognize him, right? Because it cannot be measured. Okay. It cannot be measured. I cannot form a reasonable estimate of that amount. So is him 10 million? He's better than University of UBC, right? So UBC president should be a trillion, and SFU is like a billion. So what, right? So how can we measure the value of having the president working for us, right? You cannot form a reasonable estimate. So therefore, this one should not included in the financial statement. Does that make sense? That's why you want to see.
So
yeah. Go ahead.
You were saying, so if we don't know which amount to put it wouldn't be an asset?
Yeah, you won't include him as into the financial statement.
Oh, okay.
Yeah. Because what's the point? If you put a number there, you don't even know, you don't have confidence in the number, right? What's the point to write it down, right?
But for example, we know Elon Musk is worth that number of billion.
Yeah, but the thing is, that's just the current wealth, right? When we are talking about the asset, we are talking about the future benefit, right? So do you think Elon Musk can be successful of, moving people, human beings to Mars, right? if that really happened, what is the future benefit of this person to the human race, right? So
Okay.
because I said the valuation is based on the future benefit, right? What you are saying is right now he owns this much money, but that's his cash, right? That's the value of his cash. We are seeing about what's the value of this person, right? So what's the
Yes,
value of
makes
this
sense.
person? Yeah, we cannot assign a number to him, right? We cannot assign with a reasonable estimate number of this person, right? Yeah, the number you said is the cash, the wealth he has. We want to know the value of this person. Yeah. So we cannot make a reasonable estimate. So therefore, we do not recognize them. Okay. So let's keep going. Recognition of assets and the liability. Okay, so two important concepts underlying the general recognition criteria. If an asset is going to be recorded, it must be probable that the future economic benefit will flow to the business. Okay. If you want to record this as an asset, it must be probable the future economic benefit will flow to this asset. Okay, so now think about this. I'm a pharmaceutical company. I am doing research and development work, right? So I'm trying to develop a vaccine, right? I'm trying to develop a vaccine. In the beginning, I spend money, right? I spend money through the whole process, right? So in the beginning, I will start doing some research work, right? Okay, I will do research work. I will have scientists conducting experiments, right? To learn more about the virus, right? And then I want to investigate some ways to deal with it as a vaccine, right? So think about this, right? On day one, it's a very risky project because it's not a guaranteed you will have a vaccine, right? Because this is science. You are trying to come up with a product. It's not guaranteed you are able to have find a discovery. You have a vaccine, right? It's not guaranteed. Okay, so the question is, on day one, when it's so uncertain that you will have a vaccine, okay? That means if you're not certain you have a vaccine, the future benefit will be uncertain, right? You don't have vaccine, you can't earn money, right? So do you think on day one, it's probable the future economic benefit will flow to the business?
No.
No, right? So in the beginning, those research costs, they are not assets. They are expenses. See the difference? In the beginning, because it's uncertain, you are able to come up with a product. You are able to sell the product to make money. Therefore, it's not those expenditures are not assets. You recorded them as expenses, research expenses. Okay, so it took a while. You spend money until at a certain point. Okay, you'll be like, aha, you have this there, and you're gonna have continued money to finish that research, and they're going to be the market. Everyone is waiting for COVID. For sure, there's for COVID vaccine, there's market, and you have sufficient money to finish the project. And the vaccine, you have done a lot of testings, it's going to work. So at that point, you say it's probable. Okay. So, and then you move to the next stage called the development. So in the beginning, it's called research. And then once you reach at a point, you have that your idea is very mature, right? You're gonna further develop it, make it to be a product. Then that's called a development stage. So all your expenses incurred during the development stage, those will be considered as asset. You recorded them on the balance sheet. Prior to that point, you have all this research cost. This will be your expenses, goes to the income statement. Does that make sense?
Yes.
Yeah. So for those companies like pharmaceutical companies, if you see they're gonna have development cost, they're gonna have a research cost, right? Development cost, they are part of the asset, okay? But research expense cost will be expenses. If a liability is going to be recorded, it must be probable that the future economic benefit will flow from the business to settle the present obligation. Okay, so suppose you you are a business of construction, okay? So you took a project, a contract to renovate a person's house. Okay, while you are replacing the roof, a piece of the roof fell, knocked on the head of the owner, sent him to coma, and that person passed away. Okay, so we have a problem here, right? So the construction company accidentally killed a person, killed the owner. So then the owner will probably file a lawsuit against this company. Okay, so do you think the company will be likely to pay a settlement fee to the owner's family? You are not a lawyer, I know. I'm not asking you to give like a legal opinion. I'm just saying based on your intuitive feeling, right? They were working on site, accidentally killed the owner. Owner's family filed lawsuit against this company, and the company is liable. Most likely, it's going to probably settle this problem with some money to the owner's family, right?
Yes.
Yes.
Yeah, I think so.
Yeah. So in this case, it's probable that the future economic benefit, right, will flow from business. So the cash, right, will go from the construction company to settle that obligation. So in that case, you may recognize this as a liability, but not necessary, because you have to know that amount, right? If you don't know how much money you are going to give the owner's family, so you run into the same problem of the present value, right? If you don't know the value of the liability, you still are not able to record it as a liability, okay? So let's say the lawyer is very experienced. The lawyer will say, well, I can give you a very reasonable estimate. This is going to be a $2 million settlement. Then you can recognize this as a $2 million settlement, right? Yeah. Now, if, okay, in another situation, so someone ate at your restaurant. So you have a restaurant business. There was a customer eating in your restaurant, and after that, the customer felt sick, right? And the customer believe it must be comes from the food and some poison, and then that customer died. right? So the customer family sued against the restaurant. Well, the restaurant was saying, guess what? We have like 100 people eating in the room. Nobody else have any, any bad symptoms, any problems. They are eating the same food, right? So I don't think we are going to lose the lawsuit. So in that case, it's not a probable that the restaurant has to pay money to the owner, to the customer's family, right? So in that case, you don't recognize this as a liability. Okay, you don't recognize this as a liability. Does this make sense, guys?
Yes.
Yes.
Okay, awesome.